Welcome back to What's Hot and What's Not CRE, your daily pulse on commercial real estate in America. Today we're kicking off the week with the latest on multifamily and residential. Here's where things stand heading into 2026. So let's dive right into what's hot. First on the list, the supply wave is finally peaking. We saw a massive 500,000 to 600,000 new multifamily units delivered in 2025. But here's the key. Starts have collapsed. Multifamily starts are down a staggering 74% from the 2021 peak and 30% below pre-pandemic averages. What does that mean? It means 2026 deliveries will drop about 60% from their 2024 peaks. The supply relief is coming. Second, absorption is staying strong. Job growth and population increases are keeping demand healthy. And with single-family homes still unaffordable for many, people are simply renting longer. The buy versus rent premium has eased slightly to 32%, down from 35%, but owning is still out of reach for most. Number 3 on the hot list, rent growth is positive. National rent growth came in at a solid 2 to 3% for 2025, and with that new supply shrinking, 2026 is projected to hit 3% or even higher. The 5-year annualized forecast is now 3.1%. That's above the 2.7% pre-pandemic average. Fourth, we're seeing Midwest and coastal markets really outperform. Believe it or not, Columbus, Ohio led the nation in multifamily permit growth, up over 1,200 permits year over year. New York and other coastal markets are also showing strong rent growth and occupancy. These markets just had more modest supply, so they're stabilizing much faster. And finally, investment volume is strong. Multifamily sales volume hit the $370 to $380 billion range. Cap rates are stabilizing, and capital access is improving for quality assets. Now for what's not so hot. First, vacancy is still elevated. The national vacancy rate is sitting between 4.9% and 8.2%, depending on the measure you look at. It did peak at 7.2% in November. The good news is that it's expected to drop to around 7.9% in 2026 as supply finally tapers. Second, the Belt Oversupply lingers. Markets like Austin, Phoenix, Nashville, and Charlotte are still working through a ton of excess inventory. Some of these markets saw their inventory jump 20% or more over 3 years. Recovery there is lagging. And that leads to our third point. Concessions are still common. In those high-supply markets, landlords are still offering competitive rents and move-in specials. The new Class A product is being hit the hardest. And finally, the single-family market is cooling off. Home price growth slowed to just 0.2% quarterly in the second half of 2025, and completions are basically flat year over year at around 1 million annualized. So that's your multifamily and residential update for December. The big takeaway? The supply wave is cresting, absorption is solid, and 2026 is shaping up to be a tighter, more balanced market. Thanks for tuning in.